Is the current price of Ethereum fair, or has the entire crypto market completely missed what it's actually holding? Right now, in April 2026, ETH is trading around $2,100, yet top voices in finance are publicly saying the real fair value is $60,000, not $6,000, $60,000. Why? Because they understand something the market still refuses to see. Today on the Block Analyst, we're going line by line through exactly why Ethereum should never trade like a coin, why it is not a speculative vehicle in any ordinary sense, and why pricing it the same way we price Bitcoin or altcoins is a category error of historic proportions. If you want to understand the irrational way the market prices ETH, the trillions in real economic activity it already secures, and why a massive repricing is coming, stay until the very end. This is the deepest dive you'll find anywhere. Welcome back to the Block Analyst, the channel where we dissect infrastructure plays that reshape global finance, capital markets, and the future of money. Today we break down the complete picture of what Ethereum truly is. Disclaimer. This video is for educational and informational purposes only. It is not financial advice. I am not a licensed advisor. Crypto investing carries substantial risk of loss. Always do your own research, consult qualified professionals, and never invest more than you can afford to lose. There is something deeply irrational and yet entirely predictable about how the crypto market prices Ethereum. On most days, ETH moves in near lockstep with Bitcoin and altcoins. When BTC sneezes, ETH catches a cold. Macro headwinds from Washington or Beijing hit ETH the same way they hit every meme coin. The market treats them as one undifferentiated asset class, but they are not. Ethereum is not a coin. It is not a speculative vehicle in any ordinary sense. It is infrastructure, the kind of infrastructure that once embedded deeply enough into the financial and institutional fabric of the world does not get repriced by the same logic that moves speculative tokens. It deserves its own valuation orbit. Ethereum is the world's programmable trust layer. Step by step, Ethereum today secures, settles, and provides programmable trust for a staggering and still growing volume of economic activity. Tokenized real-world assets, U.S. Treasury bills, money market funds, corporate debt, private credit, real estate, are migrating on-chain at an accelerating pace. BlackRock, Franklin Templeton, JP Morgan, and a dozen sovereign wealth funds are not experimenting. They are building production infrastructure on Ethereum. Trillions of dollars in asset flows will ultimately need a programmable settlement layer that is neutral, transparent, auditable, and resistant to capture by any single state or corporation. Ethereum is the only credible candidate at scale. No other blockchain, and certainly not Bitcoin, offers this combination: a mature execution environment, a thriving developer ecosystem, a deep L2 scaling stack, and the institutional trust that comes from years of battle-hardened security. Bitcoin is a store of value. It's trying to be good at being what it is, but it does not settle tokenized equities, run decentralized exchanges, custody stablecoin reserves, or power on-chain identity or attestations. Ethereum does all of these things simultaneously, and the economic gravity of those use cases is compounding. When the underlying asset class of an infrastructure network is priced identically to a speculative token, something is broken in the market's pricing mechanism, not in the asset. Ethereum's proof-of-stake security model is unlike anything else in crypto. Over 38 million ETH, worth tens of billions of dollars, is staked by validators who have put real economic value at risk. This is not hash rate that can be rented on a spot market or pivoted overnight. This is a long-term capital commitment, subject to slashing, withdrawal queues, and reputational stakes from institutional operators who cannot afford to be associated with protocol misbehavior. Step by step, Ethereum's liveness and integrity are backed by a deep, distributed pool of economically aligned participants who have every incentive to keep the network honest. The cost to attack Ethereum is not just computational, it is financial, reputational, and regulatory. This is fundamentally different from any proof-of-work chain, and incomparably different from the small validator sets that secure most alternative L1s. A network of this security depth should be priced for what it is: a fortress, not a casino chip. Here is the counterintuitive truth the market consistently fails to price correctly. Ethereum captures only a fraction of the economic value it enables, and that paradoxically makes it more valuable over time, not less. Step by step, the majority of economic value generated on Ethereum accrues to the protocol itself, but to the applications, stablecoin issuers, custodians, and service providers built on top of it. Tether earns billions in treasury yield on USDT reserves that settle on Ethereum. Uniswap, Aave, and Lido generate revenues that dwarf Ethereum's own captured fee income. L2 networks monetize block space they rent from the base layer at a fraction of what they charge their users. Ethereum is the indispensable substrate, and the value sits upstream. This mirrors the architecture of the internet almost exactly. TCP/IP, the foundational protocol stack of the modern web, captured essentially zero direct revenue. It enabled trillions in enterprise value across Google, Amazon, Meta, and every e-commerce business on Earth, while the protocol itself remained a commons. Nobody argued that TCP/IP was worthless because it didn't earn fees. Its value was constitutive. Without it, nothing else existed. Ethereum's current valuation largely reflects captured fees, the gas revenue that flows to validators and gets partially burned through EIP 1559. But this framing ignores two vastly larger categories of value. First, flow-based value. Trillions of dollars in stablecoin settlement, tokenized asset transfers, and cross-border institutional transactions that use Ethereum as their settlement rail at near zero cost compared to legacy systems. Second, trust surplus. The massive cost savings that accrue to counterparties who no longer need banks, clearinghouses, custodians, and legal intermediaries. Ethereum handles verification and enforcement cryptographically and automatically. Neither of these is captured in the fee revenue line. Both are real, and as valuation frameworks for digital assets mature, these externalities will force a repricing of Ethereum that is entirely independent of BTC's price on any given day.
Ethereum is a knowledge economy, not a financial asset. Step by step, Ethereum hosts the largest concentration of smart contract developers on Earth. The tooling ecosystem, Foundry, Hardhat, Veeam, WogMe, OpenZeppelin, is orders of magnitude more mature than anything on competing chains. The ERC standards process has produced a library of composable primitives, ERC20, ERC721, ERC1155, ERC4337, ERC8004, shared infrastructure for thousands of applications. Every new standard builds on the last. Every new application inherits the security, liquidity, and composability of the entire stack. This is cumulative advantage at the protocol layer. What results is continuous reinvention. DeFi emerged here. NFTs matured here. On-chain identity and attestations are taking shape here. AI agent integrations, on-chain agents that hold assets, sign transactions, and operate autonomously are being built here, with ERC 8004 laying the identity foundation and X402 enabling the payment rails. Each new wave layers atop the previous one, deepening the composability surface and widening the moat. Competing chains can optimize for throughput or lower fees. What they cannot do is replicate depth that is cumulative and path-dependent. The Ethereum developer ecosystem has been compounding for a decade. The knowledge embedded in its standards, tooling, auditing practices, formal verification culture, and adversarial security research is not a code base that can be forked. It is a civilization of builders, and civilizations are not cloned. In knowledge economies, the dominant platform sets the standards others must adopt. When a new chain wants developers, it builds EVM compatibility. When a new protocol wants liquidity, it builds bridges to Ethereum. The center of gravity is deepening, not shifting. If you trace where the genuinely consequential technical innovation in crypto has happened over the last 5 years, the answer is overwhelmingly Ethereum and its ecosystem. Uniswap invented the automated market maker. Compound and Aave invented on-chain money markets. MakerDAO showed the world a decentralized stablecoin. EigenLayer is pioneering restaking and crypto-economic security primitives. EIP 7702 and the Pectra upgrade are extending smart contract logic to externally owned accounts. PeerDAA via Fusaka is redefining data availability.
X402 is making HTTP native micropayments real, and ERC-8004 is establishing on-chain agent identity. This is a Cambrian explosion of protocol-level creativity, sustained over years. Innovation concentration of this magnitude is a moat. It should command a premium. Decentralization must be understood as a multi-layered phenomenon. At the validator level, hundreds of thousands of validators across tens of thousands of distinct operators, spanning 6 continents, multiple client implementations: Prism, Lighthouse, Teku, Nimbus, Lodestar on consensus, Geth, Nethermind, Besu, Aragon on execution. No single entity controls consensus. No single country can compel a shutdown. A bug in one client does not take down the network. At the decision-making layer, the EIP process requires rough consensus among researchers, client developers, application builders, stakers, and the community. No CEO, no foundation fiat. This slow, contentious governance is actually Ethereum's most underappreciated competitive advantage. The world computer analogy has become more accurate with time. Ethereum today hosts billions of dollars in automated financial logic, serves tens of millions of users through wallets and dApps, and provides cryptographic guarantees that replace institutional intermediaries. Stablecoin issuance runs into the hundreds of billions of dollars. DEX trading volume routinely surpasses many centralized exchanges. On-chain identity, DAOs, prediction markets, insurance, social graphs, all here. The economic activity on Ethereum and its L2s, Arbitrum, Optimism, Base, ZincSync, Scroll, and dozens more, dwarfs any comparable ecosystem. This is not potential, this is production. Finally, Ethereum is becoming a yield-bearing reserve asset. Staked ETH earns issuance rewards and a share of priority fees. It transforms from a non-productive store of value into something more like a productive bond or equity stake in a settlement network. Add EIP 1559 fee burning and future issuance reduction proposals, Ethereum's supply dynamics are structurally different from inflationary altcoins and even divergent from Bitcoin's fixed supply. A productive, yield-bearing, deflationary asset should command a distinct pricing framework. All of this leads to one clear conclusion. Ethereum is not a member of the crypto asset class in any meaningful sense. It is the infrastructure underneath that asset class and underneath much of the future financial system. Its value is direct: fees, staking yield, deflation, and constitutive, trust surplus, flow-based settlement, enabled enterprise value. Its innovation engine is cumulative and self-reinforcing. Its decentralization is structural. Pricing ETH identically to BTC on good days and to altcoins on bad days is a category error of historic proportions. The market moves on narratives, not fundamentals, yet. So let the narrative change. This is not a coin. This is the trust layer of the emerging digital economy. This is the TCP/IP of programmable value. This is essential, irreplaceable infrastructure for the next financial system. And unlike TCP/IP, it accrues value back to its holders. It is, in the crystalline and unrepeatable sense of the word, a snowflake, structurally unique, cumulatively irreplaceable, and worth far more than the market's indiscriminate pricing has ever acknowledged. The market will eventually learn to read what it holds. When it does, the repricing of Ethereum will be one for the history books. Ethereum is the programmable trust layer the world is quietly building its future financial system upon. The market still hasn't caught up, but the fundamentals are undeniable. Do you agree that ETH should never trade like a coin, or is $60,000 the fair value once institutions fully internalize this? Drop your thoughts below. I read every comment. If you made it to the end, drop trust layer in the comments. I want to know who's still here. Smash that like button if this breakdown gave you the clearest picture yet. Subscribe, turn on notifications. We're doing more infrastructure deep dives like this every week. This is the Block Analyst. Stay sharp, stay informed, and I'll see you in the next one.